There's been a very subtle change in the market that people need to understand. The rates have started to come down, that's true. Prices have not come down though, because when the rates went up, the prices stabilized. The market prices of property has kept coming up. So there's a difficulty there, because if the rates are still on the higher side and the property prices have come up, it is becoming increasingly difficult for a borrower to save up a down payment that keeps going up. It's also increasingly difficult for a borrower to make the payment because they're stuck with a higher rate, hence higher payments and a higher purchase price. One big difference we have seen on the market in the last year, 2 and 3, I would say, since the rates started going up in about 2022, is that we have more and more parents' involvement. We have more and more parents giving down payment, helping their kids, and appearing on the file. Which brings me to my next idea, Alex. There is a product that helps people save through the
FHSA.
FHSA. Tell us a little bit about it, because that's a product that we as mortgage brokers hear about, but we don't sell. This is a product that I think you could bring a lot of expertise to.
What's really, really awesome is the FHSA program that they just introduced in 2023. I like the whole living legacy, so we'll touch on that also. Moving your money from one,
generation
and passing that wealth on, and how to do it efficiently. The FHSA, if we're speaking solely about investment accounts, is the best version of the RRSP and the TFSA. It's like their child that just is way better than both combined. So it gives you a deduction on your taxes at one point, right? You're allowed to put $8,000 per year, depending on the year you opened it, obviously. And you could do this for 5 years for a max of $40,000. Now, if you put into an FHSA, you get the deduction for that year. Great. If you want to buy a house, you could pull that money out as well. Now, while that $8,000 is in the account, it's also growing tax-free, right? So we have like characteristics from the RSP and we have characteristics from the TFSA. Now, if we back up for 2 seconds and we say, okay, well, in the RSP, I could also pull out for my first-time house, right? They just changed the rule. Now it's $60,000. So if I could take out $60,000 from my RSP, but then I have to put it back over 20 years now they changed it. So I get to put it back into my RSP. But the FHSA, I don't have to put it back. It's a one-time, wham, bam, thank you, ma'am kind of account. So we put in $8,000 in 2023, if we opened it in 2023, 2024, 2025. Now you're starting to see, okay, I have $24,000 in this account. I also got back, let's say on average 30 to 40% on my taxes from that amount. And all of a sudden, if you do that for you, you do that for your wife, you've expanded completely your down payment.
So you're bringing up something interesting, Alex. In terms of the hybrid scenario over here is very interesting because you get $100,000 out of it tax-free. What I really like about the non-RSP component is the RSP, because you have to return it over time, over 20 years, that will impact the cash flow of the household. And I've seen it over the years. Cash flow is really the most important part of the mortgage. People focus on the rate. The payment is the most important. You live with the payment, you make the payment. The payment is what comes out of your account every single month, every 2 weeks, whatever the case is. But the extra RSP refunds that you need to do will have an impact. So I'm very, very fond of this new program because it allows people to have their cake and eat it too, and not be challenged in their cash flow in the future. One strategy I heard about that, I'd love to hear you chime in on this, is when your child turns 18 and you have the RESP saved up, they're there. Typically have $30,000, $40,000, $50,000 to put that money aside, $8,000 a year, and dump it into that program. Would you think that's a good idea?
That's a great question. So an RESP, if you're going to save from your child's birth until they're 18 years old, you should expect to have roughly 80 to 100,000 in that account, if done properly with the right institution. And what you could do is, as you're taking money out, yes, okay, you should be using it for school, but your contributions that you put in as a parent can also be used for anything you want, right? They could go into your RSPs, they could go into your TFSAs, they could go into your kids' FHSA, right? So we could open up an FHSA for them. I mean, if they're 18 years old and they could put into an FHSA, will they get the deductions for it, right? Are they working in order to get those deductions? That's a question. I think that if you just open up the FHSA, you throw in $100, then you now start giving your child room for the eventuality of having to pull out for a house. The RSP, there's a big component to it, right? 90 days it has to be in there in order for you to pull out. But what is the FHSA rule? Zero.
Oh, that's very interesting. I didn't know that.
Right. So if
It's a great point.
if I have enough room, I can't have the deductions that year, just open it. And then right before you want to buy your house, pull it, throw it in, pull it right back out.
So in the case of a young student who is professional first year of work, they do that. They could typically make $80,000 to $100,000 their first year. They dump in that 40, they get 20 back, and they do it right away, and they have the money right away. So the money is in right away, out, available right away, and the tax credit is generated, and they don't need to return the money. They've effectively created $20,000 per spouse available to them
Yeah.
for their house.
You want a steroid version of that?
How do you do?
Okay, so you do that with your RSP if you have the room, right? And if you could put in $60,000, you put in $60,000 into your RSP, you wait 90 days, you pull out that 60, you take 40 of that, you throw it into the FHSA, you pull it out right away for the house, and what did you just create? You just created double, right?
A bigger return, yeah.
50,000 return.
And then you just refund your whole RSP that you have to pay back for 20 years, and you no longer have those payments to make.
Yeah, but I do like I do like doing it slowly over time because there's no fees. The government doesn't charge you any fees. They don't charge you any like interest on putting it back slowly. So I do like putting the bare minimum back. Worst case, you take an income inclusion, but I'm saying I like putting it back slowly, and they give you now a grace period of 5 years to put it back.
That's new also.
Before it used to be 2 years, right? So all these things that are helping you, it does give you advantages of putting it back slowly over time. And I think you could do a lot more by taking that 50K and putting it into your TFSA, let's say, and then investing that over time. And slowly every year you reimburse $2,000 or $3,000, whatever it is, right, into your RSP.
That's very interesting.
From the interest that you're making off the TFSA.
That's very interesting, and thank you for sharing that knowledge. It's a very big piece. Again, cash flow is the key in a mortgage. Anybody and everybody who's ever had a mortgage knows that it's all about cash flow, and it's all about those payments because they got to be done for years, decades. They last not forever, but almost. So it's really important to have optimized cash flow. And thank you, Alex, for this very elaborate yet simple and elegant strategy to help people with their cash flow and have a down payment and have access to a property, because let's be honest, putting money aside is very hard, and any help you can get is absolutely going to go a very long way.
I agree. I have a question for you.
Go ahead.
So I always have clients ask me, like, should I be putting 5%? Should I be putting 20% down? And is it worth it maybe an in-between with a CHMC or not?
So again, we come back to the cash flow position. So if you're putting a 5% down, if you're a first-time home buyer, you can now go on 30 years. So that's on a cash flow position, that's not so bad because you have the 30-year. But keep in mind that extra 15% is reflected in your monthly payments because you're not putting it down, because you have to make a higher payment to make up for the smaller down payment. On top of that, you're paying an insurance premium. There's no straight answer to this, but I would tell you that typically, if you're able to put 20% and save on the premium, you should. If you're not able to, do not delay your purchase transactions, do not delay your plans, because things don't typically get better over time. Au contraire, they get a little bit more complicated, and there's more challenges and there's more things to look at. So if you're able to buy property now with 5%, by all means do that. If you're able to put 20, that's great too. I don't like so much the 15% because I feel like you're so close to 20 and you're not benefiting from it and you're still paying the premium. So I tend to tell people 5 or 10 or 20, 15 seems like a compromise that doesn't really have much benefits. Again, if it's all you have and it's what you want to do, it's fine, but maybe try to push yourself a little bit more to that 20 mark.
Would it be worth it to maybe ask like your parents or whatever for an in-house loan for that extra 5% to save on the CHMC?
Loans are frowned upon by the bank because they come back with repayments. So banks like to see a gift letter. So that's what is the requirement. So if your parents want to gift you the money, that's amazing. Any immediate relative, parents, brother, sister. Now we're seeing some kids give to their parents because we have a generation that's a bit more affluent than the preceding one. So that would be okay, but a loan would absolutely be frowned upon, as is borrowing the down payment on your line of credit, because those payments will obviously impact your ratios. So it could work, it could still work, but the impact of the ratios will tend to be very significant if we borrow the down payment. And
is there a certain amount of time that the gift has to be in the account in order for them to, or it could be just like a week before purchase? Or
it varies by institution. Some want it at the notary. Some wanted deposited at the time of the transaction. Some wanted 30 days before closing, 15 days before closing. That really varies by lender. It's a conversation to have when we select the lender together, because at that point, if there are intricacies or there's sometimes a tax implication to a certain timing or a certain date for the gift, it's important that we talk about it ahead of time so that we choose a lender accordingly that will match their policy with your situation.
Beautiful. Choosing a lender, is that the hardest part or the easiest part?
If you actually know what you're doing, it's generally the easiest part. Because that comes with experience. So I'm a broker for mortgages, you're a broker for insurance, and typically you know that certain companies will say, you know what, this type of activity, not really for us. This type of issue, not really for us. And others will say, yeah, no problem. So we have lenders that are very fond of self-employed people. Some, I'm not going to say they're less fond, but they don't give any grace to a self-employed person for allocations, let's say for car expenses or whatever, that they might pass off in their tax returns. So some are more tolerant, some are a bit more tolerant on credit, some are a bit more tolerant on ratios, and some are extremely rigid. Typically, the more rigid ones will have slightly lower rates. So those are the rates that you see. So those are the rates that you see advertised everywhere. The problem with those rates is you usually get what you paid for. So if you're getting a very, very low rate advertised, it's usually come with a significant amount of restrictions, and you will find out. Now, you might fit into that box and you'll find out that it's great for you, or you might not. And at that point, we'll talk about it. But choosing the lender is a crucial component in making sure that things will be well aligned with the borrower's needs, with the family's needs, and that they will have what they want. And the other component that's also very important, I like to do it for cash flow purposes, is the capacity to add a line of credit when possible.
HELOC.
HELOC, exactly. It's a great product. Some lenders allow it, some lenders don't. It's great. It's saved so many households because life happens, things happen, cash flow issue happens, situations occur, and you need a little bit of liquidity. Credit cards are extremely expensive. Cashing out investments may have a tax consequence. Cashing out insurance policy will have consequences. Using the money in the HELOC temporarily, very affordable, very low rates, very easy to do, easy access, easy return, low interest. It's probably the most important component of a stable family household liquidity.
It's beautiful what you just said, because every client that we speak to that we're doing planning for that's about to get a mortgage, we always ask them, like, ask your broker if they're putting a HELOC on it. And so the first question goes, well, what's a HELOC? Right? What's a home equity line of credit? Why is it important? Why should I have it? And then they come back and they're like, oh yeah, he didn't propose it to me. Why are certain brokers not proposing HELOC? And certain are proposing HELOCs?
So there's a couple of parts there. So the HELOC usually comes at a slightly higher rate because you have a fully liquid capacity to borrow, whereas a fixed rate mortgage has a guaranteed return to the bank. So the HELOC is usually prime or prime plus something. So it's a bit more expensive. The other thing is the HELOC component cannot be added in and above the 80% financing. So if you're taking an insured loan, CMHC or Sagen, you cannot get a HELOC. You can get a line of credit on the side, perhaps, if you qualify, but you cannot get a HELOC. The HELOC typically occurs when you have at least 20% down, and at that point, you should get it if you have 20% or more. Or sometimes what we do is we do the 80% mortgage, and the HELOC gets created as time goes along. So every time you make a payment on your mortgage, $1,000, $2,000 a month against capital, that amount gets liberated on the HELOC portion, and you have access to a HELOC. So very quickly, a year or two in, you already have $20,000, $25,000, $30,000, $40,000 available to you in that HELOC for your various needs.
Very cool. There is a very cool strategy that you could do with a HELOC, actually. So for investment purposes, right? Now, this is a very risky strategy because now you're not gambling with your home, but you're gambling with your home. But if you have HELOCs on other properties that you might own, what's really cool is you could take that HELOC and invest it, right? Obviously, my rule is always 2x. So if you can make twice as much in an investment than you will on the interest, then you'll win. Because you have to pay back that interest, plus you want to keep some. Plus you have to account for taxes. So, but what could you do is you could also deduct the interest if you're doing it for business purposes, correct? So if we're pulling out of the HELOC in order to invest, I think that's a great way in order for people to maximize their wealth, right? Using leveraging and loans in order to build more wealth. Would you agree?
Again, so you started with the risk part, and I respect you for doing that a lot, because that is the first thing that people need to understand is there's a risk component, and when you're borrowing money to invest it, you are doubling your risk. So you definitely want at least double the return, because risk and return need to be in correlation. Don't play with money you can't afford to play with. Play with money that's available to you in excess capital, in excess liquidity. If it's on a revenue property or whatnot and you're able to deduct it, that's also a bonus. Obviously, if you're using it for business purposes, that's great. But keep in mind also, if the business purposes go down to zero, you also lose that ability to deduct it. There's been several cases, Supreme Court, whatnot. It doesn't fly. So you have to be very careful with that. I like the strategy, but you also have to mitigate the risk and control the risk level that goes with it. And typically, that's really where knowing your client, knowing yourself as a client, and knowing your capacity, your tolerance for risk, and for your family, that's where it comes in. That's when the judgment part, the analysis part, and the sheer knowledge of the product and of the people comes into play. Alex, one of your clients actually reached out to me last week, mentioned something about a HELOC, a life insurance. I must admit, I don't really understand what she was talking about, but I'd love to hear it from you and get the professional perspective on it.
So what's really awesome about certain life insurance policies is that so in a life insurance policy, if we back up a little bit, we all understand that life insurance is if you die, they pay, right? If you don't die, they don't pay. That's the typical life insurance policy that you have. Now, there are other types of life insurance policies that are more permanent, whole life, that forever you'll put into it or for a certain amount of time. And you could also leverage them while you're alive. So there's what we call cash value in these policies. Now, how do you leverage a policy, right? You have to look at life insurance as an asset, as opposed to looking at life insurance as just, I pay, I die, I get paid, or my family gets paid. So life insurance now became an asset class. And especially if you're going to put it through a holding company, well, now you're going to be saving a lot on taxes. So if you could take a life insurance policy and put money in this life insurance policy, it will grow what's called the cash value. Now, I always tell people, how do you take money out of a building, right? What's the best process of saying, I have a building, it's worth $2 million. When I originally bought it, it was worth $1 million. How do I take that extra $1 million out? I mean, you call David.
Hopefully, yes. Hopefully, financing is the answer.
Yeah, you call David, you go, you get to the bank, and you refinance the building, the asset. It's the exact same thing with life insurance. Once you have enough cash value, which is usually $100,000 in this life insurance policy, you could go to a lender, and you could leverage it.
Alex, what you're telling me, it's not really a HELOC. It's an AELOC. Or an IELOC, it's an insurance equity line of credit.
That's interesting. Yeah, I guess you could call it that way. The way that the lenders are doing this, such as like Manulife Bank, Equitable Bank, CIBC is doing it, Scotia is doing a lot of these. So these banks, what they're doing is they're opening you up a line of credit, and they guarantee you an increase on this line of credit every 5 years. So for 5 years, they follow the illustration of the insurance policy. And they say, fine, if this year your cash value is $100,000, next year it's $140,000, the year after it's $200,000, they'll increase your line of credit for you by that amount for 5 years. You obviously have to qualify for it. So
of course,
don't think it's as easy as 1, 2, 3, like everyone pitches on social media. But once you do, and you get this line of credit, now you use it for business purposes, right? So what can you do with this? What can you do with this cash? Well, I could buy real estate. I could invest in the stock market. I could buy shares to another business. I could do a lot of things. Once I borrow off this HELOC and I use it for business purposes, as we said before, well, I could deduct the interest off of it, right? So now it's better for my business. And this is all done through the holding company. You could do it personally, but it's going to cost you a lot more money. So if you could find a way to move money from your holding company to this policy, which is an asset, and then back into your holding company to use it, well, now you just created two assets.
So you're growing and you're leveraging based on the cash surrender value of your life insurance policy.
Correct.
So I'm really glad you explained it to me, because the way it was told to me was not that, but the details you brought a lot of clarity, and I'm really grateful for it. Thank you.
My pleasure. If you want to go one step further with this concept, if you take, because they'll probably lend you between 80 to 100% of the cash value, but you don't want to borrow the whole amount. In case you get into financial problems later and you can't pay it back, you want to give yourself une marge.
A buffer.
Yeah, a little buffer, right? So if you're borrowing from it and then you're using it for other business purposes, like a building itself, when you refinance a building, does the value of the building stop growing? It keeps growing. Same thing with a life insurance policy. When you leverage it, the cash value still keeps growing, right? And the beauty of it is that when it's growing in the life insurance policy, there is zero tax. When you leverage it, zero tax. When you die, zero tax. So what you just did is you created an asset with your life insurance, an asset that you're buying with the leveraging, and then on top of it, I mean, it's not a plus if you die, but if you die, you pay off that line of credit, and now you have two different assets.
Well, you have the assets. Your family doesn't have the liability.
Correct.
So the insurance is paid out.
And more.
And more. The cash surrender value pays off the line of credit and more. And effectively, you've left your family with significantly more assets than you could have initially have done based only on the saving component that you were investing into the life insurance policy.
And the best part, it's not the best part when you pass away, but if you pass away, you have what we call capital gains tax, right? Mm-hmm. We have estate tax to pay. That is usually wiped out by this insurance policy. So you wipe out the loan and you wipe out the tax if planned properly and done properly. So imagine leaving your entire estate tax-free to your beneficiaries.